Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for 𝗧𝗴𝗀. Today is Friday. It is October the 8th. And what do we do on Friday? We talk about a review of the week. We talk about all the biggest threats, the opportunities, what to look out for, what happened, what can we take away from this week's trading session. But first of all, let me start out with my analysis, and we'll kind of work into the week, into what happened this week and what we can expect next week. Markets are a little kind of random, really. I mean, they're a little bullish, but nothing really. The Dow Jones is up 31 points. Remember, if we're up less than 75, 85, it's random. It really is. Now, all eyes are on the bond market. The bond market's actually going to open up a little higher. We have a sell stop at 142.50 for a hedge, and I put this hedge on in the beginning of the week just in case the market did crap out. The market didn't crap out, and the bond market's actually a little lower. I personally think we're going to go higher on the bond market over the next few days, but we do have our stop at 142.50. So if we open there in the morning, we will get stopped out. I may consider reinitiating the position depending on if the bond market sags again or not. Based on what we're seeing right now, and I'll just kind of go through the Nasdaq right now. The Nasdaq 100, we're still in danger zone. We're not out of this just quite yet. Now, because we're between the 50-day and the 200-day moving average. Now, if you look at the Russell 2000, the small caps, they're actually looking quite better. It's actually trading above the 50-day line. But if you look at most other indices, like the Dow Jones, you will see that we're still not quite there yet. We need to go above the 50-day line. Momentum levels, well, let me show you what's going on right now. If you look at the Nasdaq now, we now have 35% of stocks trading above the 50-day line. Earlier this week, the number was a lot less. We were all the way down below this line, and now we're going higher. And I think we're going to continue moving higher. And that's a 3-month chart. If you look at a 10-year chart, look at where we bottomed out. And remember what I showed you. If you look at a max, how many times did we breach this level? 1, 2, 3, 4, 5, 6. So it's not like an everyday occurrence, and there's a good chance this will hold. And if that holds, there's a good chance the stock market will go higher. And if it does go higher, there's a good chance that the Nasdaq 100 or the S&P, let me just show you the S&P, will in fact begin trading above the 50-day moving average. The bottom line is, even if we trade between the 50-day and the 200-day, that's the 50-day line and that's the 200-day line, which is the area I call the twilight zone, that means the market will be choppy. And if the market is choppy, we could still trade this market. My swing trading setups work really well in a choppy market. It's this market that it doesn't do well in. I mean, this is from 460 to 430. But we didn't do so well. We had a stop loss on Microsoft that got triggered, and then the stock turned around. But we didn't get stopped out on Adobe. I believe we're going to be taking profit earlier. I mean, maybe later today or tomorrow. I'm not sure. I'll have to check. Or not tomorrow, Monday. And we have a UNH trade we're going to be getting out today, probably at a fairly small loss. It went up 10 points today, and it's a little higher. But if the market was stable, our pullbacks would be trading pullbacks from the upside. They wouldn't be as extended, and the upside would be better. But if you look at the underlying assets of our swing trades from beginning of this week and the actual underlying level in the stock, we haven't, and I'll review that actually. If you're in my session today, I'll review those positions today. But the bottom line is, our lows that we picked were not all that off of the actual lows. So we did pretty good on some of these trades in terms of picking the lows. And again, it's not the easiest market to trade right now. Now, in terms of the news, global news, what do we have today? Markets are waiting U.S. jobs data on Friday that might influence the Fed decision on when to roll back stimulus after lawmakers averted a possible government debt default. That's what's on the table today. Lawmakers agreed to extend Washington's borrowing ability into December, thank God. Lack of agreement might have led to a default experts say would set back recovery from the COVID pandemic. Labor Department reported a number of people applying for unemployment fell last week. So this is the jobless claims. The actual number were 326,000. Today we have employment numbers. I'm not looking at the actual number. I'm looking at the percentage. I like to look at the percentage of the unemployment claims. I think we're looking at 5.1%. I wouldn't look at this non-farm payroll. I mean, we're like all over the place. 250,000 to 650. Why not just make it 1 to a million, right? The unemployment rate is what I'm looking at. And if the unemployment rate is 5, it'll be better for the stock market than if it is 5.3. But I got to tell you, ISM numbers were good. Factory numbers were pretty good. ADP numbers going into today's report from Wednesday, that's a private report that reflects on today, was good. Jobless claims was good. There wasn't any really negative data. And if you look at the indices, which we'll look at right now, if my stock fetcher works, it works all the time except when I'm with a live camera here, right? Murphy's Law never fails. So let's look at the indices. Financials are breaking out at making all-time highs. Does that happen when we're about to enter a bear market? No. Energy, look at energy. That's expansion. I know we have a little shortage, but that's because of expansion. Remember, energy went south during COVID. Healthcare, well, it's been kind of on a dump, but it's going higher. It's starting to come up, and it looks like it went about as low as it's going to go. Utilities, not so bullish on utilities right now. And utilities actually is one of the few sectors that got negative revisions going into next quarter. Oh, yeah, and every sector except utilities, and I think consumer staples got a positive revision. Again, consumer staples and utilities, I'm not a fan of right now. Basic materials we'll have to watch carefully with industrial. Tech can go either way right now as well. Consumer discretionary. Consumer discretionary is on fire. And that's, again, that's a very, very, that's the most retail spending focused sector. So it's doing actually really well. It's kind of ironic that the most speculative sector is leading, but I like consumer discretionary. And I would be focusing on financial, energy, and consumer discretionary stocks right now. If that's what I would be doing. Financial, energy, consumer discretionary. That's what we got on the table going into next week. But again, in terms of, let me just show you here. In terms of volatility, look. Volatility is below 20. VIX is now out of danger zone. It's below 20. Look at that. We couldn't even go this week, far up as we did the previous week. Put to call ratio, probably random if I had to guess. Yeah, 90, right? I mean, look at that, right in the middle. Not up here anymore, in the middle. So it just doesn't look like there's much on the table. But again, we have the employment data this week. We have the employment data in about, it's 7:22 right now. I'm trying to do these videos real early so they get posted really early. We have the employment data. Keep your eye on the bond market. We've got a stop loss at 152.50. If the bond market, if the number is really, really strong, it's going to be very negative for the bond market. But if the number is really weak, which I don't think it'll be really, really bullish for the bond market because it'll reinforce the fact that the Fed can't do anything right now, or soon. I don't think that's going to happen. But again, we're out of danger zone. This was just a bonus trade for upside. It's good that it didn't work out. That means the market didn't crash, actually, believe it or not. So we may get stopped out of it, but again, we have to be defensive. I'd rather give you a bond position to put stop losses that get hit for nothing. So keep your eye on the employment data and keep your eye on healthcare, energy, and consumer discretionary as we head into next week. And there's another sector I want to take a look at, and I think semiconductors. That's another sector that I'm really liking right now. Yeah, I like the semiconductors. We're still in the zone, but I do like the semiconductors. I think we're going to go choppy. But I mean, look at XLY. Look at this thing. I mean, this is consumer discretionary. That's the most speculative sector, and it looks to be going higher. And if that's the case, the Fed will not tell us with a straight face that they're not going to take action when consumer discretion. They're not going to tell us with a straight face that the economy is suffering if consumer discretionary is making all-time highs and economy is expanding above their 5.1 or 5.2%. So it's going to be very, very hard to do that. They're going to try, but it's going to be hard. So keep your eye on the market. Most importantly, employment data, consumer discretionary mixed with tech, not hard tech, consumer discretionary mixed with tech. What was those three sectors? Let's see. Let's go back here. Where are we here? It was the energy sector. It was consumer discretionary sector. And it was one more sector. Let's take a look here. Financial, energy, and consumer discretionary. Now, folks, before you go, I've got something very important, something timely, and something you need to pay attention to. Now, why get stuck doing all the research when traders can have decades of knowledge and experience in one membership? With overdrive profits, and we're taking a ADI trade profit this morning on it, I believe, members have the opportunity to multiply their gains and grow their trading account as fast as possible. And this isn't just a place to get trades. Members also get multiple strategies, private trading materials, and exclusive tools to push their trading success into overdrive. That's right. Not only will members get a chance to make gains like 75.64% on Albemarle, 64.63% on Kroger, but you'll also be able to learn how the pros trade with all of the priceless trading resources available. You don't want to miss out on this. Click the link below to take advantage of this amazing deal. It's only being offered for a limited time. You do not want to miss out. And folks, make sure to like these videos, subscribe to this channel if you're watching on YouTube. You've got to stay ahead of the market by being the first to be notified when I post my next video for you. And how else are you going to get these goodies? Don't miss Monday's video. I'm going to talk about the biggest threats, biggest opportunities. I'll give you the best sectors on Monday based after today's employment data. I'll give you the pullbacks on the way up and the way out, and we'll do a full momentum review. How about that? If you guys are getting something out of these videos, send me an email, support@marketgeeks.com. I want to hear from you. And have a great weekend. Stay away from anything non-related to consumer discretionary, financial, or energy over the next 24, 48 hours. And keep your eye on the bond market today. It may get hairy. Bye.